Let's continue our discussion about financial statements and we'll talk about balance sheets. The balance sheet answers the question of where does my business stand today? What do I own and what do I owe? So it's going to balance your assets, what you own, against the financing, which could be either debt or equity. But the balance sheet is a snapshot. It shows your financial position at a given point in time. So let's work through a balance sheet to get a more thorough understanding. And assets are on the left-hand side. We have liabilities and equity on the right-hand side. And the two always have to equal, hence the name balance sheet. We have what we own, we got to balance it with how we got it. Did we get it through debt, which is liabilities, or did we get it through owner contribution, which is equity? So let's start with our assets. With our assets, we always start with our most liquid asset, and our most liquid asset, obviously, is cash. Can't get any more liquid than cash. To that, we add our accounts receivable. Accounts receivable are items that we have already sold on credit. So typically most companies that have accounts receivables that they've sold money, they sold items on credit, they've had a track record with these individuals or retailers that have purchased their product, and they know how long it's going to take for that to cycle through and for them to receive payment. Accounts receivable, we generally consider that less liquid than cash, but for most large companies that have been in business for a long time, their accounts receivable are very dependable. And to that, we add inventory. Now, inventory is the least liquid of our current assets. Together, these make up our current assets. And inventory is the least liquid, and it's the least liquid because there's a lot of uncertainty concerning your inventory. Maybe you've made a product that no one wants. Then it wouldn't be very liquid at all because you would have to sell it at a major steep discount in order to get rid of it. So, for most established companies, their inventory is valuable. They know that they're going to be able to sell it. They have a long track record of doing so. And so your concern with inventory should go hand in hand with company history and past success. Our current assets are those assets that we expect to convert to cash within 1 year. So we expect our accounts receivable and our inventory to be converted to cash within 1 year. To that, we add our fixed assets. This is our property, plant, and equipment. Fixed assets are long term. We expect to have them for a long time. And together, these make up our total assets. Now, fixed assets can have other things in there too, like sometimes you'll see goodwill is mixed in with fixed assets. But it's typically property, plant, and equipment. So these were our most liquid. We worked from our most liquid to our least liquid. And you may not be familiar with the term liquidity, but liquidity means how easily it can be converted to cash. How liquid is your investment? Can you sell it today and not take a huge loss on it? So for some stocks, even if you were an institutional investor and you were investing large sums of money in companies and you held a huge block of stock, it may not be possible for you to sell all of those at a given moment and not affect the stock price. And even some companies, they have very illiquid trading. So you as an investor, you purchase that stock, you may not be able to sell it for what it's worth. You may be able to have to sell it at a discount just to get some liquidity. So we're going to balance that with how we got it. We're going to balance our assets with how we attained those assets. And on the liabilities and equity side, we start with our most short-term liabilities and we work to our most long-term. And of course, long-term goes hand in hand with equity. That is long, patient capital. It was contributed by the owners. So our most short-term of liabilities are our accounts payable. Now, the biggest source of credit in the country is trade credit. Trade credit is the money that your suppliers extend to you. So, for example, if you owned a restaurant and the bread man dropped off your bread on Monday, he would expect payment for that next Monday. So he extended you trade credit. It doesn't take a lot of difficulty to get trade credit. Most companies are willing to extend you at least some, and as long as you maintain a good track record, they'll continue to allow you to keep that credit going. Now, if he comes back next Monday to drop off more bread to pick up payment and you don't have that, then he's not likely to leave you any new bread. So accounts payable is very short term. Those suppliers expect payment promptly or they will not provide you with any more goods. Next, we have our notes payable. Notes payable are very short-term debt, usually with 1 year or less maturity. These make up our current liabilities. Now, current liabilities go hand in hand with current assets. Remember, current assets are those assets that you expect to convert to cash within 1 year. Current liabilities are those bills you expect to pay within 1 year. To that, we add our long-term debt. Long-term debt is debt that we typically use to finance our fixed assets. Now, in this country, it is a very big problem when we mismatch our sources and uses of funds. So, for example, if you're using long-term debt to fund your accounts receivable, that's a mismatch of funds. That's not necessarily as detrimental as using notes payable to finance your fixed assets. So then you would have a very hefty payment trying to pay for this fixed asset in a very short period of time. So lots of companies get into big trouble because they don't finance their assets correctly. This gives us our total liabilities. To that, we add our equity, so our shareholder equity, to get total liabilities plus equity. And remember, the two sides have to balance. So this was our short term, and this is our long term. So here's an example. I kind of breezed over the shareholders equity component, but typically shareholder equity is broken down into different segments. So you might have a preferred stockholders line, then you would have a common shareholders line, which would be further broken down into the stock's par value, the paid in excess of par value, and then you have retained earnings to give you total shareholders equity. So it's several different lines. And here we can see that. There's some interesting things that we need to consider when talking about stock. We've talked a little bit about how preferred stock is quasi-debt in nature. So it is equity. It is owners contributing funds for ownership in the company. But unlike common stock, preferred shareholders are promised a dividend. So they have that debt-like component where they're promised this fixed payment every period, much like debt holders are. So the interesting thing about preferred stock is that there are two different ways that you can set up your preferred stock. First is you can make it non-cumulative, which simply means that if the company is unable to or unwilling to make preferred dividends this period, they don't have to make them up. So they could just skip this period. They don't have to make it up next period. If the preferred stock is cumulative, that means that every preferred stock dividend that is missed has to be made up. So if they missed preferred stock dividends for 2 years, they would have to pay all of those dividends in arrears before they could pay common shareholders anything. So let's look at this example and let's see what happens. So we have a company. The preferred stock was issued 5 years ago. All dividends on preferred stock for prior years have been paid. So they're up to date. They're current. Now this is 9% cumulative preferred stock. We have dividends declared of $6 million. So let's calculate the total dollar amount of dividends that are paid to the preferred shareholders in the year ended March 31st. So the way this is, preferred stock can have a stated dollar dividend, or it can have a percentage dividend. If it's a percentage dividend, it's always a percent of par. So here the dividend owed to each preferred shareholder is 9% of the par value of $100. So each preferred shareholder is to receive $9. So we have 300,000 shares issued. So collectively, we owe our preferred stockholders 9 times 300,000. So that's $2.7 million. Now the second part of the question asks us how much dividends or what is the dollar amount of dividends paid to the common shareholders. We see that dividends declared are $6 million. We have to pay our preferred shareholders first, so we pay them $2.7 million. And so that leaves us owing our preferred shareholders the remainder of $3.3 million. So how much does that mean that each shareholder will receive? If we take $3.3 million and we divide that by the 20 million shares outstanding, then we get 16.5 cents per share. So $3.3 million, which is what shareholders are being paid collectively, divided by 20 million shares of common stock outstanding, we find that each shareholder is being paid 16.5 cents. Now let's run a different scenario. Let's see what happens if dividends last year had been skipped. So the company did not pay any dividends last year, and now they're paying the $6 million in dividends. So with that, because this preferred stock is cumulative, we have to pay both last year's dividend and this year's dividend. So we already said that the preferred stock has a $100 par value, and their dividend is 9% of that. So each preferred shareholder is receiving a $9 dividend. There are 300,000 shares of preferred stock. So that's $2.7 million owed per year to preferred shareholders, but we missed last year's. So we have to pay this year's $2.7 million and last year's $2.7 million for a collective payment to preferred shareholders of $5.4 million. So now the remainder of that, so this goes to preferred shareholders. Now the remainder of that goes to common shareholders. So if we declared $6 million in dividends and we're paying $5.4 million to our to our preferred shareholders, that only leaves us $600,000 to distribute amongst all 20 million shares of common stock. So 600,000 divided by 20 million is equal to 3 cents per share. So 3 cents per share. So you can see how that really cuts into the preferred or to the common shareholders' dividends. We'll also quickly cover the statement of retained earnings. The statement of retained earnings reconciles income earned during a given year and any dividends paid. With it, it's going to look at how that changes the retained earnings balance from the beginning of the year to the end of the year. So this company had retained earnings balance in January 1 of $1,012. They had net profit after tax of $231. They paid dividends to the preferred stockholders of 10. I'm sure this is in thousands or millions. And to common shareholders, 98. So total dividends were $108. So their retained earnings balance went from $1,012 to $1,135. So the net increase in retained earnings for this company was $123.